Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Oracle.
If you find our talks useful, please consider subscribe, like, and comment underneath. Imagine a 49-year-old legacy enterprise company.
Right, the kind of organization that, many casual observers probably thought was just a relic of the 1990s.
Exactly. But suddenly, they're outpacing the absolute hottest Silicon Valley artificial intelligence startups.
It's wild.
It really is. So today, our mission is to break down this massive, totally landscape-shifting third quarter fiscal 2026 earnings report from them.
And for you listening, we're framing this entirely as a crucial wealth-building study.
Yeah, we're going to unpack exactly how a legacy giant completely redefined its trajectory. I mean, almost overnight, they became the definitive bellwether for the entire AI sector.
It really is a masterclass in corporate pivoting. We aren't just looking at, a good quarter here.
No, not at all.
We're looking at a fundamental shift in the market's hierarchy. Because when you're looking to build long-term wealth in the tech sector, you have to deeply understand the difference between companies that are just riding the AI hype cycle and companies that are actively, aggressively monetizing it.
Right, the ones actually making the money.
Exactly. And today, we are dissecting the latter.
I gotta admit, looking at the initial market reactions to these earnings, the numbers almost felt like a misprint to me.
Oh, I know.
For a company this established, it's just rare to see this kind of explosive momentum from a legacy player. So walk me through the actual data. How big was this beat?
It was staggering across the board. So to give you the baseline, total quarterly revenue hit $17.2 billion.
Wow.
Yeah, that represents a 22% increase year over year. But the bottom line is where they truly shocked Wall Street.
Okay, lay it on me.
The adjusted earnings per share came in at $1.79.
Okay, and the expectation was?
To put that into perspective, the consensus analyst expectation was sitting way down at $1.23.
Wait, really? $1.23?
Yeah. They didn't just edge out the street estimates, they completely shattered them.
Beating earnings per share by over 50 cents on a legacy tech stock is, well, it's almost unheard of.
And that is exactly why the market reacted the way it did. I mean, the law of large numbers usually dictates that a company of this immense size simply cannot grow top-line revenue at 22%.
Right. Mathematically, it requires moving mountains of capital.
Exactly. But it wasn't just looking backward at the past quarter that caught institutional investors off guard. It was the sheer forward-looking confidence from management.
Oh, the guidance raise.
Right. They actually raised their fiscal 2027 revenue guidance by a full $1 billion.
Just casually tossing $1 billion on top.
Pushing the target up to $90 billion. An analyst consensus for that period was only $86.6 billion.
You know, the analogy that comes to mind here, it's not the old cliche of strapping a rocket to a freight train.
What is it then?
It's more like taking a massive millions of tons cargo ship that has been reliably, slowly hauling freight across the ocean for decades and suddenly retrofitting it to lift out of the water and glide on hydrofoils at speedboat velocities.
That's a great visual.
It just defies the physics of a company this large. But where exactly is this acceleration coming from? Like, what specific segment is driving this?
The primary engine is their cloud and AI infrastructure.
Mm-hmm.
Overall, cloud infrastructure revenue surged 84% to $4.9 billion.
84%. Okay.
But the specific metric you really need to pay attention to is their AI infrastructure revenue, which grew by an astonishing 243%.
Okay, just so we are completely clear on the terminology here for you listening, when we talk about AI infrastructure in this context, we're talking about the physical data centers, right?
Yes.
The massive clusters of specialized processors, the servers that companies rent to train and run their AI models.
Precisely. It is the digital concrete and steel of the AI boom. And that 243% growth number is the critical wealth-building signal for you as an investor.
Because it shows people are actually buying.
Right. It proves that this demand is not speculative. The infrastructure segment accelerated from 68% growth in the prior quarter to 84% this quarter.
Which means it's speeding up.
Exactly. It shows that enterprise adoption is actually accelerating, not leveling off.
Yeah.
Companies are writing the massive checks right now to secure computing power.
Okay. But this brings up a massive financial reality that we need to decode here. Explosive growth in AI infrastructure is notoriously phenomenally expensive.
Oh, absolutely.
I mean, buying tens of thousands of advanced processors, securing the power grid access, literally pouring the concrete for the data centers. It's one of the most capital-intensive undertakings in modern business history.
It really is.
So how are they funding this unprecedented build-out without completely destroying their profitability and, taking on crippling debt?
This brings us to what is arguably the most important number in the entire earnings report, the remaining performance obligations, or RPO.
Okay, RPO.
Their RPO rocketed to $553 billion.
Wait, I'm sorry. Did you say billion?
Let me repeat that. $553 billion.
Oh my God.
That is up 325% year over year.
Over $500 billion. That number is so large, it's almost hard to conceptualize.
It is massive. RPO essentially represents contracted revenue that has been signed but hasn't been recognized on the income statement yet because the services are still being delivered over time.
Okay, so it's a backlog.
Exactly. It is the ultimate measure of revenue visibility. And what's happening behind the scenes here is an incredibly innovative funding mechanism.
How so?
They are securing upfront customer funding and prepayments for these massive AI infrastructure contracts.
Oh, wow. So it's essentially like a general contractor getting a massive multi-year cash advance from a client to build a skyscraper.
Yes, exactly that.
Because the client pays a huge sum up front, the contractor doesn't have to go to the bank, take out a high-interest mortgage, and drain their own savings to buy the steel and the glass. They use the client's money to build the client's building.
That is the perfect way to look at it.
Yeah.
This mechanism profoundly de-risks the expansion.
That's brilliant.
It is the secret sauce that allows them to maintain their pristine investment grade rating while scaling at light speed. By securing these massive prepayments, they are effectively decoupling the immense capital expenditure burden from their own balance sheet.
So they aren't even carrying the risk.
Right. They aren't bearing the full upfront cost of the AI data center build-out alone.
Yeah.
Their enterprise customers are essentially financing the construction because the demand for computing power is so desperate.
And looking at the margins, it proves the strategy is working, right? Because the AI infrastructure gross margins are sitting at a very healthy 32%.
Yep.
And the broader AI data center business is operating at 30 to 40% gross margins.
It's incredible.
So they are scaling rapidly, using customer money to fund the physical expansion, and still maintaining massive profitability on the back end.
Which is the holy grail when you are evaluating a long-term holding for wealth generation. Growth at all costs, which, we see in a lot of younger tech companies, eventually catches up with the balance sheet.
Definitely.
Profitable, de-risked growth with $500 billion in contracted backlog is how generational wealth is compounded.
Okay, so they have a mountain of customer cash. But this leads me to a very obvious question.
Sure.
If I am the chief information officer of a Fortune 500 company, why am I handing them $1 billion prepayment?
Fair question.
Like, why aren't these enterprises just giving that money to Amazon or Microsoft, who have historically dominated the cloud computing space?
Right.
What is the unique competitive moat here that is winning these specific deals?
It comes down to two foundational concepts: data gravity and what the industry is calling the Switzerland strategy.
Switzerland strategy, I like that. But let's start with data gravity.
So in this quarter, their multi-cloud database revenue exploded by 531% year over year.
Wait, data gravity, can you break that down for the listener? You mean the idea that massive amounts of enterprise data are too heavy, too complex, and too expensive to move across the internet?
Exactly.
So you basically have to build your artificial intelligence applications right next to where the data already lives.
You nailed it. Think of it like a massive physical library, right? If you want to do research involving millions of books, it is incredibly inefficient and expensive to pack up all those books, put them in trucks, and move them to a new building across town.
Yeah, that would be a nightmare.
Right. It is much easier to just build your new research laboratory right inside the existing library. For decades, the world's largest banks, healthcare networks, and governments have stored their most critical, sensitive information inside Oracle databases.
Ah, so they already hold the keys.
Exactly. That data has immense gravity. To get real value out of modern AI, you have to combine frontier language models with your own private, mission-critical data. And because they hold the data, they have the ultimate proximity advantage.
That makes a lot of sense. But let me push back on this Switzerland strategy you mentioned.
Sure, go ahead.
They have recently forged these highly publicized strategic partnerships with Microsoft, Google, and Amazon to unlock demand across multiple clouds.
Yes, they have.
But wait, aren't Microsoft and Amazon their fiercest historical rivals?
Absolutely.
Why on earth would you partner with your biggest competitors and let them into your ecosystem instead of fighting for exclusive dominance?
Because it is a brilliant strategic pivot that exploits the exact fear enterprise customers have regarding those rivals.
Which is what?
If we look at the psychology of the modern enterprise, CIOs are absolutely terrified of vendor lock-in.
Oh, sure. Being stuck.
Exactly. If a massive company puts their entire infrastructure, all their computing power, and all their mission-critical private data into one single cloud provider, like Amazon or Microsoft, that provider essentially owns them.
Right.
The switching costs become functionally impossible. If that provider raises prices by 20%, the enterprise just has to pay it.
They are completely trapped in a walled garden.
Right. So by acting as the neutral multi-cloud player, the Switzerland of the cloud wars, they eliminate that fear.
I see.
They went to their customers and said, you can use Amazon's or Microsoft's computing power for your AI models, but keep your mission-critical database safely running on our neutral architecture. And the beauty of this is that they essentially forced Microsoft and Amazon to play along.
Wait, how did they force them? I can't imagine Microsoft was exactly thrilled about sharing the revenue.
They weren't. But the enterprise customers demanded it. A massive banking client essentially tells Microsoft, we want to buy your AI compute, but we are not moving our database. So either you integrate your cloud with Oracle's database, or we will take our billions of dollars in compute spend over to Google.
Wow. So Microsoft and Amazon had no choice but to agree to the integration.
None at all. By doing this, they have established a switching cost moat that competitors simply cannot replicate.
And that deep integration is already happening on the software side too, right? I saw they integrated over 1,000 new AI agents into their existing software as a service offerings, like their enterprise resource planning and supply chain tool.
Yes, exactly. They aren't trying to win the walled garden war. They are positioning themselves as the indispensable neutral foundation underneath all the walled gardens.
That's fascinating.
And as we just discussed, that is a tremendously defensible moat.
So, okay, we understand the massive number, we understand the funding mechanism, and we understand the multi-cloud moat. But what does this all mean for the broader market? And more importantly, for the listener's portfolio? The fundamentals are stellar, obviously, but wealth building requires an understanding of timing and market awareness. Let's look at the market reaction and the future catalysts.
The market reaction was violent in the best possible way.
I remember looking at the chart that day.
On March 11th, 2026, the stock saw a massive surge, closing up roughly 10.43% to $160.48. And at one point during that trading session, the intraday moves were over 12%.
I want to pause on that price action for a second. Moving a stock with a market cap of hundreds of billions of dollars by 12% in a single day, that is not something retail day traders on a message board can accomplish.
No, not even close.
That requires billions of dollars of institutional capital, mutual funds, pension funds, massive asset managers aggressively flowing into the name all at once.
Absolutely. And it had a massive ripple effect. When a single stock reports earnings and it lists the entire AI and neo-cloud sector, it acts as a true bellwether.
Right, they pulled everyone else up with them.
We saw specialized cloud companies like CoreWeave, which provides dedicated GPU computing rally just on the strength of this report.
Wow.
The big money saw these infrastructure growth numbers and immediately repriced the entire sector. They realized the AI infrastructure build-out is far from over. It is actually accelerating.
And we also saw JP Morgan step in and issue an upgrade right after the report.
Yes.
Which, adds a crucial layer of institutional credibility for wealth builders looking for validation from major Tier 1 banks. But we can't just look at what happened yesterday. What is on the horizon?
The major near-term catalyst is the fact that Wall Street analysts are currently scrambling. That guidance raised to $90 billion for fiscal 2027 means analysts across the board are having to frantically revise their earnings estimates upward.
Because their models were just wrong.
Right. Their financial models were fundamentally broken by this report. They were simply too low.
Which means we were walking into a setup where the street is actively adjusting their price targets higher?
Exactly. We have the Q4 fiscal 2026 earnings coming up in late May.
Okay, May.
The current expectations are an EPS of $1.96 to $2 and revenue growth of 19 to 21%. But given the massive $553 billion backlog and the momentum we just discussed, the market is already going to be pricing in a beat.
So there's an opportunity there.
Definitely. This sets up a very clear potential swing trade target of $175 to $185 leading into that late May report.
Okay, that's short term. What about further out?
Looking a bit further out, you have their massive Cloud World event in September 2026, which historically serves as a major launch pad for new product announcements and drives significant positive momentum.
Okay, the bull case is incredibly compelling, but let's take a breath and look at the macro realities here.
Sure.
No investment is bulletproof. To make sure you listening are fully informed and making objective decisions, we have to impartially explore the execution constraints and the external risks.
Always.
What is the actual bear case here?
The single biggest risk factor right now is supply constraints. Their AI infrastructure demand currently far exceeds their available supply.
Meaning they can't build fast enough.
Quite simply, they are selling data center capacity much faster than they can actually build it.
Let me stop you there, because having more demand than supply, especially in high-margin enterprise technology, sounds like a luxury problem.
It does sound like it.
Every business wants a line out the door, right? Isn't it a wildly positive signal that they are completely sold out?
In a normal industry, yes. But in the artificial intelligence arms race, it is a massive vulnerability.
Why is that?
Speed to market is absolutely everything right now. If an enterprise wants to train a new AI model to beat their competitors, they need that computing power today, not in 18 months.
Ah, I see. So if they can't deliver the servers fast enough, those impatient customers will just, take their billions of dollars and go back to Amazon, Google, or Microsoft.
That is exactly the risk. Building a modern AI data center is incredibly difficult right now.
I can imagine.
You have to secure access to local power grids that are already strained. You have to wait in line for massive electrical transformers that are back-ordered globally.
Right.
You have to implement advanced liquid cooling systems because these new chips run so hot, and you have to actually secure the allocation of the GPUs themselves.
So there are a lot of bottlenecks.
Yes. If execution falters on any of those fronts, that massive revenue visibility could evaporate as customers jump ship. Execution on scaling the physical infrastructure is the single most critical metric you must watch.
That makes perfect sense. A $500 billion backlog is only valuable if you can actually build the product to fulfill it.
Precisely.
And beyond the operational constraints, we can't ignore the broader macro environment.
No, we definitely can't.
We're looking at significant geopolitical tensions right now. The ongoing situation with Iran, oil prices pushing back above $90 a barrel. These factors create broader market volatility that can drag down the valuation of even the strongest fundamental performers.
The macro volatility is very real. But this is where we loop back to why this company is so uniquely positioned.
The backlog again.
Yes. That staggering $553 billion RPO acts as one heck of a shock absorber against those exact macro headwinds.
So it insulates them.
Exactly. Even if oil stays at $90, even if inflation ticks back up and the broader stock market gets choppy, they have $500 billion of contracted, legally binding revenue locked in.
Wow.
It doesn't make their stock price perfectly immune to a broader market sell-off, but fundamentally, it provides a massive concrete floor under their valuation that most other tech companies simply do not have.
So let's bring this all together. What is the final thesis for the wealth builder listening today?
When you synthesize all the data points we've unpacked, the 84% cloud infrastructure growth, the margin expansion funded by customer cash, the genius of the neutral multi-cloud moat, and the massive $500 billion backlog, the ultimate investment thesis yields a 9 out of 10 bullish score.
A 9 out of 10, that's high.
It is. The only thing keeping it from a perfect 10 is that very real execution risk on physically scaling the data centers.
And mapping that out on an actionable timeline for a portfolio.
For wealth building, you have two distinct horizons to consider here.
Okay, what's the first?
First, a shorter-term swing trade upside leading into the Q4 earnings in May 2026. As Wall Street analysts are forced to revise those earnings estimates upward over the next few weeks, we are targeting that $175 to $185 range.
And the second horizon?
Second, for the long-term foundational portfolio, this is a multi-year 12 to 36-month hold targeting $250 or more.
250, wow.
Yeah. As the secular cloud and AI trends fully mature and that massive contracted revenue actually hits the bottom line, the fundamental value of the company will dictate that price expansion.
It truly is a remarkable pivot from a legacy player. But I want to leave you with a final, lingering question to ponder on your own.
All right.
Given this massive wave of cash generation, this totally unassailable multi-cloud moat that sits underneath all the major players, and the fact that the broader AI market is inevitably going to face a period of consolidation, could this company transition from being just an infrastructure and database provider to becoming a massive acquirer?
That is an interesting thought.
Right. With their expanding war chest, could they start buying up the smaller, innovative AI software companies and completely reshape the tech hierarchy as we know it?
That raises a fascinating possibility for the years ahead. It is definitely something to watch closely as this capital continues to accumulate.
Absolutely something to keep a close eye on. Thank you for joining today's analysis. We hope you can apply these insights to your own wealth building journey, and we'll catch you next time.